everyone, and thank you for joining our latest edition of Fiducient Features. I'm Brad Long, our Deputy Chief Investment Officer at Fiducient Advisors. I'm happy to be joined by David Polak from Capital Group. So Capital, whose wide-reaching umbrella includes American funds, is a global asset manager with over 90 years of investment experience in 2.4 trillion with a T in assets that they oversee. David is an equity investment director with Capital and has over 38 years investment experience. So David, thanks for joining us.
You're welcome, Brad. I might add a couple of things just for context. In addition to the assets, we have 176 equity analysts, and our analysts all invest, and they're in many ways the eyes and ears of our investment approach. In 2020, we did 20,000 company meetings a year. And for those of you with short memories, 2020, we were all locked in our homes. And the prior year, we did 15,000 where we were out on the road. And the reason I mention these numbers is it gives us some insights, maybe 1,000 points of light on what is going on around the world. And that's important when we enter a period of uncertainty. And this last quarter that we are finishing today, which has been quite exhausting for many people, has had two major uncertainties. Firstly, the realization that we are seeing a major pivot in monetary policy, certainly in the United States, almost certainly in Europe. And we can talk about that in Q&A if people are interested. But the topic today is the other major issue that occurred during the quarter, and that was a land war in Europe, Russia's invasion of the Ukraine. And so Brad and I were chatting before, and we thought we would cover three main areas. Firstly, the impact on Russian securities. What on earth is going on there? Secondly, the second derivative, if you like, what are the impacts on inflation in Europe? What are the impacts on certain industries? Are we more or less excited about some of these opportunities and risks? And then thirdly, some of the geographical implications, wider geopolitical issues, and of course, what looms large in everybody's mind is China. And so those will be the three topic headings: Russia, second derivative, China. So let's start with Russia. As the situation began to warm up with troop maneuvers around the Ukrainian border, we put a prohibition on purchases of prohibition of purchases of Russian companies. We wanted to ensure that we weren't buying into something that we had little insight over. There are times when geopolitical or macro forces can swamp our particular skill as investors, and our skill is in picking companies that we think have got good long-term prospects with reasonably attractive near-term prices. That doesn't account for anything if the world goes slightly crazy. And so we wanted to ensure that we were thinking about risk in your portfolios by not purchasing any more. In other words, sometimes as an investor, you want to be a contrarian, but there is a limit to how many burning buildings you should run into. So that meant that when we came into the crisis, as President Vladimir Putin decided to send the tanks in, and we had lower exposures across pretty much all of our strategies than the relevant benchmarks. That was helpful, but small comfort when we had to write those securities down to zero. The process for that was firstly the Russian stock exchange prohibited any foreigner from selling a listed security on the Moscow Stock Exchange. And that was shortly followed by the major banks suspending trading in the American depository receipts or global depository receipts. And for those who are less familiar with the arcane maneuverings in the financial world, a depository receipt is something issued by typically a US or a European bank that is backed up by securities of that underlying company. So a Gazprom global depository receipt will be issued by, say, Morgan Stanley or Goldman Sachs, but they will have a hedge of 10 or 20 shares in Gazprom on the Moscow Stock Exchange for every depository receipt that they issue. These are dollar denominated, they're traded on stock exchanges in places like London and New York, so attractive for many investors who are looking to invest in recognized stock exchanges, but ultimately backed buy the securities in Russia. And so if you are Morgan Stanley or Goldman Sachs, you have a duty to your shareholders not to have extraordinary positions in Russian securities. So in a very short period of time, I'm talking about 48 hours, we and others were unable to sell any securities in Russia. And that is why pretty much all of us have written them down to zero. We go from here? Yes.
To that end, we know practically, right, we can't buy or sell in the country today, but I'd be interested in Capital's view on if we were to wave a wand and, we can buy and sell and the market begins to function again, the move against Russia, not just by countries and sanctions, but even companies. Over 200 companies have decided to either discontinue, limit, or reduce operations in Russia. Does Russia become an uninvestable market from a fundamental perspective, or is that a short-sighted view with some of the recent volatility here?
I think it's a reasonable view to take. I mean, there are always opportunities within these situations. So in this scenario that suddenly we're able to trade, I think the vast majority of investors at Capital Group would take the view that Russia is either uninvestable or it's really complicated to solve, and there are much better opportunities elsewhere in the world. There will, however, and we pride ourselves on having cognitive diversity, there'll be others that say, most people think that. But if I take a, say, several-year view, there is a possibility, not a probability, a possibility that things could change. Who knows? And I'm buying companies that have reasonably good assets at very low prices. So I think, when you put all of that together in our portfolios, you will find one or two small positions in Russian securities in the scenario that you were to map out. I think the difficulty is, you can take a company like Gazprom and you can say, well, it's interesting because gas and oil, some of the second derivatives have gone up because of concerns about supply. And these are gas and oil companies. So even though they're Russian, surely there's value in those assets. The problem is, of course, as you rightly point out, with sanctions, it means that Gazprom will be reliant probably on one customer, maybe two, China and India. And they're not going to pay top dollar for the gas. So the assets actually are probably attenuating. They're probably at some level, they're worth less than they were before sanctions. And I think that'll be the majority view, but there will be people who would say, you know what? Yandex is an extraordinarily good internet property, happens to be in Russia. I can buy it at 10 cents on the dollar. Maybe I'll just put a bit of money in there.
Fair enough. And, as we think about the knock-on effects, right? So there's Russian listed securities, right, that are legally or geographically based in Russia. But, as we mentioned, over 200 companies have exited Russia or stopped selling into Russia. The likes of Nestle, IKEA, ExxonMobil, JP Morgan, American Express, right? And to some degree in some of these businesses, that's maybe more posturing than it is practical given limited operations there. But for others like McDonald's, who announced shutting kind of temporarily 850 stores in the country, that's real revenue, right? So maybe as we expand beyond just the borders of Russia and think a little bit more 3D on the impact and kind of the interconnectivity of companies and economies, how is Capital addressing kind of those knock-on and secondary or tertiary effects?
It's interesting, to use a couple of examples. Carlsberg pull out of Russia, and that's a big part of their business. Does it change our view on the company? No, because the price has reacted. We can actually buy what we think is an extraordinarily attractive set of beer assets at very low prices. And we'd never really had a great deal of comfort in the Russian businesses, for reasons that have transpired. So a lot of times companies pulling out of Russia, it removes a concern. I think many people on the call are aware of growing degrees of ESG focus. And many companies that have a lot of exposure to Russia were already in the eyes of folks asking people, why are you there? So to some extent, I think you could see a drop-off in earnings in these companies, but an increase in the valuation that people are willing to pay. And that'll often be an offset and sometimes maybe even an attractive purchase. Then you've got the sort of the next, maybe the third derivative, which is Germany, for instance, will almost certainly have to wean itself off Russian gas. So how are they going to do that? Are they going to restart their nuclear program? Unlikely. They may slow down their rate of decommissioning. Are they likely to stoke up, pardon the pun, their coal industry again? Probably not. Germany has a real commitment to net zero at both political and corporate level. So therefore, they're most likely to want to import gas. And the way they would do that is through liquefied natural gas. Now, there's an arbitrage. Henry Hub, the natural gas LNG price here in the United States is $5.50. Just a few weeks ago, it was $55 in Europe. So producers, transporters of liquefied natural gas are interesting investments, as are the companies that will construct the liquefaction plants in Germany that will actually have to take the gas off the tankers and bring it back into, the gasification plants, which will then be able to take it from this frozen liquefied natural gas into something that can go into people's homes and businesses. Then, of course, there's the whole renewable energy business. And so that makes mining companies in Chile that produce lithium attractive. It has knock-on impacts for copper companies because copper is an important element of electrification. If we're all going to charge our Teslas as we drive across the country, we need more charging points. And if you're going to have charging points, you need more copper. So there's lots of knock-on effects that just come from this supply-demand mismatch in terms of commodities. And that's just hard commodities, and that's just oil and gas. I haven't even got to agricultural commodities. Ukraine and Russia produce something like 25% of the world's corn and 20% of the world's wheat. That has enormous implications for fertilizer companies, for agricultural companies like Archer Daniel Midland or Bunge, or Bunge as it's pronounced. And you can see then how the ripples begin to move out in terms of risks and reward. And of course, a macro implication is for inflation. So food prices are going to go up in Europe and the Middle East. If food prices go up in the Middle East, you're going to see imports into Europe from the Middle East also go up in price. And because, back to your point, Brad, a number of these companies are taking earnings hits, you're going to start seeing economic growth begin to slow down. And so you could get a really nasty period of stagflation where you see Europe in a recession and inflation going up. We do some work looking at sticky inflation and flexible inflation. So flexible inflation is things like food prices, oil and gas, whereas sticky is rent, healthcare, those kind of things. Sticky inflation is holding steady, but flexible inflation is roaring up, and that's in the US. And the Fed are now working on that. I mentioned that earlier. In Europe, it's been pronounced by what's happened in the Ukraine. So thinking through those impacts on companies, economies, and the ripples that go out and affect each other is really an important part of what we do. And that's where those 1,000 points of light, 20,000 points of light are really helpful. Rather than listening to an economist tell us what's going on, and economists are always gloomy, we can actually say to companies like, what are you seeing in the world? Like, how's this affecting you? In a lot of cases, they say, we don't know yet, but we think this might happen. But it's helpful. We put it together as a mosaic.
Yeah, speaking of economists, which are also like weathermen, they're mostly always wrong, but nonetheless, you mentioned Europe and the knock-on effects, right? And so consensus CPI in Europe, has risen from 2 to 5% recently. Similarly, consensus GDP growth has, fallen by about 20% across Europe. And I know you mentioned Germany and the, Nord Stream 2 pipeline and kind of waning off from gas there, but I think most investors, maybe just because of geographical tangency, but obviously of the economic tangency to Russia, have been thinking about Europe as really bearing the brunt of these costs. So I know as you talk about 20,000 or more points of light, does that do those points of light point to a different opinion in Europe and the potential negative effects there? Or is it really more of this kind of ripple effect that you were talking about, where it's maybe acute in some areas, but it's not as just geographically tangent as one would simply say Europe, Russia impact?
Yeah, it's a very interesting question. I'll just look at one of our global funds, and the reason I look at the global funds is they can invest anywhere in the world. So what these 20,000 points of light tell us, where they can invest in American companies, Asian companies, European companies, I think is interesting. And with all of the concerns in Europe, and we share many of them in terms of economics and certain industries, we have 24% of the portfolio. The strategy is New Perspective. It's a global multinational fund. 24% of the portfolio is in European companies. The index is 16%. So it's only a quarter, but it's a lot more than the benchmark. So why is that? Well, the companies that we're invested in are companies like Airbus and Safran. So they're benefiting from the rebound in travel. Companies like Louis Vuitton and Hermes. And no matter what the world seems to throw at these companies, it seems that the reaction of wealthy people around the world is to buy more Birkin bags. It seems to be an incredibly sustainable business model. We're invested in companies like AstraZeneca, at the forefront of healthcare innovation, BioNTech, which is the company that partners with Pfizer for the COVID vaccine. We're invested in companies around medical technology, Siemens Healthineers, and companies at the forefront of this electrification process, Asea Brown Boveri, that I mentioned out of Switzerland, and Schneider in Paris. So what we're finding is lots of world-class companies happen to be domiciled in Europe. And the interesting thing is that if you were to take those companies and look at where they earn their revenues, as a whole, roughly a third of their revenues come from the emerging markets, a third of their revenues come from the United States, and a third come from Europe. And so Europe could come under pressure, and then the euro could go down, which would affect the share price. But of course, 2/3 of their revenues coming from China and the United States would now be worth more, whereas their margins, would expand because their costs are low. So there's an offset there. So I think it's one of those points about you can get quite gloomy looking at the world from the top down. But if you look again from the bottom up at what companies are experiencing, there can be shafts of light. Now, having said all of that, we'd be very wary about European banks, European retailers, European telecoms, European real estate companies, European utilities. There'd be a lot of pressure on these companies in the scenario that we see. So it's really about stock selection.
Yeah, and the inelasticity of greed, I guess, is a topic that we can leave for another day, but that would be an interesting one to unpack. But nonetheless, as you mentioned, kind of cautious of certain sectors, right? You mentioned banks, you mentioned utilities, and one that comes to mind is having lived a very acute part of the exogenous shock here is agriculture and the energy sector. So what, if anything, has the recent rise in conflict in Europe shifted views on a sector basis? And maybe that's been organically grown in a change in view from the bottom up, or it has been, to your introductory point on sometimes a macro view can swamp a bottom up fundamental. Have there been shifting winds from a sector basis?
Not so much. We tend to invest over very long time periods. The largest component of a portfolio manager or an analyst's bonus here at Capital Group is their 8-year investment results. So we're typically trying to get a handle on what we think a company will be worth anywhere between 5 and 8 years from now. And so even major shifts brought around by conflicts often have very little impact on most of the portfolio. Having said that, we have been feeling pretty optimistic, constructive about a number of the commodity companies. The long-term thinking is that unlike oil, it's much harder to bring supply on when it comes to mining. Oil really depends on the discipline of the companies because particularly in places like the Permian, one can, or companies can really turn on the spigot very quickly. There's plenty of oil out there, whether that's in Saudi Arabia or in Texas or in other parts of the Middle East, but it really does, it's whether or not the price is attractive enough for supply to pick up. And when the oil price is at 100, there's a reasonable chance that we're going to see more and more supply coming on. Mining is much harder because you actually have to go and dig a new mine. And since 2010, the large mining companies, and it's much more oligopolistic structure in mining than it is in oil. And sorry for using a long word like oligopolistic. What that essentially means is there's much tighter control of supply. There are fewer companies. They all decided that they would reduce their capital expenditure 10 years ago. And so there've been very few, if any, new mines that have been dug. And so if the demand for copper goes up, which we believe it will, the supply is limited. If the demand for lithium goes up, et cetera, et cetera. So we see some really attractive opportunities in the supply-demand balance for commodities. Then you get the Russian shock. And Russia produces not just a lot of oil and gas, but a lot of metals. And so that's a real opportunity for companies in places like Chile, places like Brazil, and places like Australia. There is the sound of picks and shovels in Western Australia as they're digging for all sorts of things that people can no longer get out of Russia. And of course, we sift a little into the third part of the commentary, which is China. There's already been a lot of concern about some of these rare metals, these important metals for electrification coming out of China. So there's already been work underway to find different sources of these rare earths and metals for batteries. And that again has been enhanced by what's happened in Russia.
Yeah, it seems, China was happy to take a breath as Russia took center stage for a little while here. But, the commentary keeps creeping back to China, as you noted, and for good reason. China is Russia's largest export, this world's second largest economy. And there's, at least in a simplistic basis, somewhat of a parallel interest in sovereign growth between Russia, Ukraine, and China, Taiwan. And obviously the economic ramifications of similar sanctions or issues in China relative to Russia would be far more wide-reaching. So, as investors have and prices have reflected, China's down a reasonable amount this year. Has that stirred either interest or concern across the 20,000 points of light, or to your point, on a 5 to 8 year time frame? It just doesn't come into the math.
I think there's a couple of forces at play with China. One is the ongoing concern about regulatory clampdowns, and so I think it's important to sort of look at the context of how events are unfolding in China. In October, we have the 20th Party Congress, and it's the 20th of a series of 5-year plans. And the Chinese Communist Party has, for 80 years, got together and said, okay, here's the next 5-year plan. And they figure out who's in charge for that next 5-year plan. So that's coming up. It's a big deal. And President Xi wants to get re-elected for an unprecedented, I think it's third term. So coming into this, China is really focused on harmony. They want social harmony. They want people happy so that President Xi can get re-elected. And so that means they want to clamp down on industries that have been earning supernormal profits, the internet. So they're promoting common prosperity. And that's led to a wave of regulation that has rather unnerved investors who had made a lot of money in Alibaba and Tencent and others, and then suddenly over a weekend it was gone. And excuse me, that has meant a lot of people have kind of stepped back. And in a similar way as we were discussing about Russia, a number of portfolio managers here have said, it's a hard way to make money. I can do all of this work on a company and really feel it's in a great place. And then I wake up on Monday morning and the Chinese have just regulated it out of profitability. So that's been going on in the background. And we have in the Biden administration a renewed focus and a slightly different focus on issues with China. So the Trump administration was, perhaps, they were deploying some blunt tools. The Biden administration are deploying different tools, but nevertheless still putting the pressure on China. So one of the big issues at the moment is whether Chinese companies will allow the SEC to access their audits. And without that, will US investors be willing to invest? And so that's ongoing at the moment. And that's really not got anything to do with Russia, but people look at it in the same light. So that's one set of concerns, regulatory issues. The other set of concerns is, will the confrontation that the US and China as two major economies have at the moment, could that heat up into something a little bit more dangerous? And I think that the view we're getting from our Shanghai office, we have a significant Shanghai office as well as Hong Kong, is that if anything, the heat around Taiwan has gone down. So I come back to this point about harmony. The Chinese administration, we believe, are privately furious with the Russians for creating disharmony, uniting the West. And in doing so, they've showed the Chinese what the West is capable of if it unites, in terms of applying sanctions to a country and companies pulling out of a country. And the Chinese look at that and they go, that wouldn't be very harmonious if that happened to us. Our 20th Party Congress would be a bit of a mess if we rattle our saber too much around China. Now, they're not going to say any of this. They're not going to say to the Chinese population that they're going to sort of pull their horns in Taiwan. So you're going to continue to see it play out in the media, and they'll send the on airplane over the Taiwan Strait and everything. But what we're hearing from people who we think have good information is that the Chinese have put back any plans they had on Taiwan by at least a decade. So interestingly, coming out of this Russian situation, there might be a slight dampening down. And despite all the public bluster and rhetoric, coming into the 20th Party Congress, you might actually begin to see some healing between the US and China. And that could be interesting. That would be something that the market is not anticipating at the moment.
Well, David, we're at the top of the half hour here, came by very quickly, but we want to thank you and Capital for all your comments and continued stewardships of many of our clients' assets. If there's any questions that we didn't get to that were put in the queue or that you think of afterwards, please feel free to reach out and we're happy to address them. But David, thank you once again.
Thank you.
Have a good one.